Volatility is often a word that has, a negative connotation. People hear volatility, they don't like volatility, they don't want volatility in their portfolio, but volatility is a primary component that goes into options pricing. So if you buy options, you actually own volatility. And so when volatility increases, you make money off the increase in volatility. When you have assets near all-time highs like they are, it's a good time to be looking for diversity. So a lot of people look at safe haven assets. Take gold, for instance. It could be a safe haven asset, or it could not be. It really depends on what central bank policy is and what's happening to interest rates. Volatility historically has always been a safe haven asset when you have periods of stress in the market. Because when the markets sell off, whether it's equities or credit spreads or real estate, investors who own volatility benefit because volatility increases in the market. If you're short volatility and it increases, and we saw that in February 2008 with equity vol increased and a lot of people were short the market, you can lose a lot of money very quickly. So an option is a type of derivative that has an asymmetric payoff. The reason it has an asymmetric payoff is because volatility is one of the factors that goes into pricing the option. So when people talk about volatility markets, they're always talking about the options markets. There are really 5 main types of volatility markets. Equity volatility, but there's also credit volatility, so corporate and investment grade credit, an emerging market credit. Then there is FX volatility, so foreign exchange markets, whether it's dollar yen or Aussie yen or any of these pairs. Then there's commodity markets, from coffee to soybeans to gold. And then you have rates. So the rates market is actually the biggest. So it's a derivatives market based on interest rates. There are lots of different ways to access volatility markets. The easiest way to access the volatility market is through either mutual funds or ETFs, where retail investors can have exposure to an asset class in a systematic way, but they don't have to be personally trading the options on their own.